Good morning, folks, and welcome to Swing Trading Today. I'm going to start off with a request, and that request is this. I was up waiting for my daughter, who looked gorgeous with her friends last night, who went out to their prom, waiting for her to get home safely. And I was up at 4:45 in the a.m. Eastern Standard Time preparing for this video. So what I'd appreciate is if you could, for my efforts, give me a like, subscribe to my channel, and leave a comment below. What do you like and what do you not like about these videos? What can I do better to make these videos more entertaining and more informative for you as a trader? And also let me know, when you give me your feedback, what kind of trader are you? Short-term, day trader, longer-term investor, etc. I really appreciate that feedback because I adapt to the communication. So that's my request this morning. Happy Friday. Let's get to it. It is at current 5:07 in the a.m. Eastern Standard Time. What we're going to do this morning is we're going to kick things off with something that'll make a lot of people yawn. I've been talking to a lot of members of late, and I keep good communication with prior members, and I ask for their feedback. And some say, you know what, Bob, I just want to hear about stocks that you're looking to trade. If that's true, leave a comment below. Sometimes people do not like the economic data, but I think that it is essential. I have competitors out there, they'll talk about their trips to Bali, the Lamborghinis they supposedly own, and the jets they supposedly own. Listen, folks, I'm never going to buy a Lamborghini. It's a depreciating asset. I will go to Bali. Would I rent a private jet? Maybe if I'm going to split it with somebody. I grew up poor, so I think about the things that I could do with that money, like double it in a year. Why wouldn't I do that? So first class is good for me. I'm fine with that. But sure, maybe one day I'll spend the money to go flying private. It's not my cup of tea. I would rather invest the money or travel. Okay, so I digress. So this morning we're going to kick things off with a bit of a twist. And it is a chart that everybody should know about. It is called the yield curve. Then we're going to segue into member stock chart request. That's where we review the symbols that our gold members submit for me to review. And then we're going to segue into what the markets are doing in the pre-market. And I'll give you my thoughts about how we're going to open today. So let's get to it. All right, the first chart up is going to be the yield curve. The yield curve is a measure of the spread between the 2-year Treasury yield and the 10-year Treasury yield. Some other traders use different bond spreads to measure. This is my preferred, and it's the one used by most economists. And what you're looking at here, this jumble of mess, is a story. It's a story of a bygone era. Scratch that. It's a story of bygone errors in time. Back here, the recession of 1990. Back here, the shallow recession of 98. Back here, we all know what this was, the dot-com crash. Back here, the financial crisis. So I have these periods of time outlined in blue. What do they signify besides the fact that we went into recession? The yield curve went from positive, meaning the 10-year yield paid more than the 2-year yield. That's traditionally what's supposed to happen. The longer the duration of the bond, the higher the yield. But back during these time frames, the yield curve inverted, meaning short-term treasuries paid more than longer-term treasuries. So that's a conflict. It's a conflict of the Federal Reserve jacking up interest rates a bit too much and investors simply not willing to lend long out for 10 years. And so those spreads collapse. So what we're looking at current day is that we are collapsing. I have been talking about this with members for months. There's nothing to do here but watch, right? You can't go shorting the market based upon where we're sitting right now because you'll lose your shirt. But you need to be aware that this is on the horizon. It's like a freight train coming down the tracks. It's the market sending us a signal that all is not well with this economy. And how do I know that it's not time to go shorting based upon this horrific chart right now? Simply look back in time, right? Back here in 1998, if you would have shorted the market, it would have been a shallow correction, and good luck timing that one. It was very brief. Back here in 2000, if you shorted prior to late 2000, it was after the inversion of the yield curve, you would have gone broke because we went parabolic prior to yields finally getting alleviated, the acknowledgement of recession, and a major correction which is on the horizon. You need for the markets to finally begin to break down. Now, what you're looking at right here on the S&P 500, if I didn't say it's overlaid here in blue, my apologies. What you're looking at here is a possible double top forming. Not yet. It's not validated yet on the S&P 500. Now, when do we know it's validated? When we put in a lower high. That's not enough, though. That's only part one. What's part two? Part two is when we break down to lower lows. That's the confirmation. That's the market saying, okay, the music has stopped. Everybody grab a chair, but there aren't going to be enough chairs. There's not going to be enough safety. People are going to get burned. That is when we are going to be looking to short this market in earnest. Now let's get to the stocks that we are watching to trade, as well as some members' stock chart requests that our gold members submit for me to review. A couple of these I went over on, I think it was Monday. The first one was Costco. I mentioned on Monday that Costco was looking good. It would probably break out. It did break out. We saw some topping action yesterday on Costco, meaning you have a wick, shadow, candlestick. I think what we may get here is a pullback and a retest of the breakout point. I'd be a buyer of the shares on that pullback. So we will be sending out trade alerts to members on the buy and on the sell. I was speaking to a member the other day. He's a member of another service as well. I was in shock that the service provides a buy signal, but doesn't give a sell signal. I found that laughable. So if anybody is in question about what we do, I send out signals on the buy and on the sell. I digress. So Costco looking good. I'm concerned, though. I'm concerned about this entire market, folks. Watch out for volume. Volume has been coming in light. When you're breaking out, especially two, let's go to a monthly chart to illustrate. Especially two all-time highs. What a beautiful chart. You want to see volume rising. Volume has been very weak on Costco. So while I'm still willing to trade Costco long, I'm concerned about the volume bars. They may rise, but hope is not a strategy, right? So let's keep an eye on volume. We have our indicators, RSI, Stokes rising, good stuff. Lower highs on Ultimate Oscillator. Now, why this has caused this lower high here is because while we did break out, we sold off the highs of the day. And that influences the Ultimate Oscillator. So you don't want to keep seeing a rally and then sellers moving in. That's profit taking. You want to see net accumulation. You want to close at the highs of the day. All right, so this is a warning flag. You have a couple of them here. Pay heed. Deckers. This is another one I talked about on Monday. I mentioned that it would probably rally on this bullish key reversal. It did rally. We are very close to a closing breakout. We did put in a new all-time high, but we couldn't close there again. Much as what we saw on Costco, we closed off the highs of the session. Now, if we fail to break out. Because what I always like to say is the test is always at the top. If we fail to break out and we roll over and we break down below the lows of the 19th of June, which is at 117.27, you have to avoid these shares because now we're putting in lower closing highs and now lower lows. I wouldn't go shorting the shares because it's still a strong stock. It could bounce back. And the path of least resistance on a longer term basis is still up. We need to be careful. So while I still think the shares can be bought on a breakout, I have a warning flag on the track. Grubhub. We booked profits on Grubhub. We made a handsome profit several days ago. And we were leaning into the third standard deviation Bollinger Band. We booked profits. I said, let's wait for a pullback to either A, this secondary uptrend line, or B, a more favorable support level, this one right here. Now, we did close down below this support level, which leads me to believe that we're probably going to get a pullback to this lower band of support. Now, I'm going to be looking to rebuild our position of Grubhub, assuming that the market holds up. So members, on all of these symbols, if we execute a trade, I will be sending out a buy signal and a sell signal. Volume on Grubhub has been well above average, so this is a problem. This is a signal by the market that, you know what, you certainly have more sellers and institutional sellers at that leaning into the shares, either shorting or booking profits. You don't want to fight these guys, folks. We're small traders. I have several institutional members, but for the most part, I have small traders. This is not mom and pop selling 100 shares. These are big block traders. Do not fight these guys. They will win every single time. You need to allow these volume bars to drop down a bit. Do not fight them. They want you to fight them. GOS, Canada Goose Holdings. This is what I had to say about GOS on my last swing trade today. GOS. Now, I was very bullish on GOS. In longer term, I may be bullish on it. We were bullish on GOS from back here down in the 30s. It's now up in the mid to high 60s. This goose is cooked for a while, folks. If you are long of these shares and you are holding on to profits, don't lose your profits. Do I believe that it's going to collapse? No, but I do believe that we are going to pause and pull back. We're looking to short the name. And that short, the logic behind the short has nothing to do with the fundamentals. That has nothing to do with the price target of dropping back down into the 30s or crashing into the 10s. Nothing of the sort. All I'm looking to do is to scalp a profit off of a pullback, which I think is going to be short-term aggressive. We have RSI on a daily basis at 93.26, and we are leaning into the third standard deviation Bollinger Band. In short, if you're not familiar with what all this means, we're not supposed to be here on a relative basis. These are foolish longs getting long of the shares at extended prices and shorts who are weak getting squeezed. Simple as that. As contrarians, we want to identify the unsustainability of this move higher, and we want to take advantage of it by shorting into this unsustainable overbought condition. Again, we're not betting that GOS is going to drop like a rock down even into the 50s. It may not. I may even think about getting long of it 2 weeks from now. But we are going to get a pullback. As sure as God made green little apples, it's going to happen. Ideally, though, these volume bars need to drop off further. Still too much ridiculous enthusiasm driving these shares higher. So members, more to come in terms of strategy. All right, so that's what I had to say. I mentioned that we were at extreme overbought levels, that this was unsustainable. Now, many people say that, you know, Bob, you execute these trades. Well, I didn't execute a trade on this one. A couple of members did. I did not. But I frequently do make these trades that are either A, extreme overbought, or B, extreme oversold. And a lot of people think that I'm catching a falling knife or a rising sword. And I'm not. Why? It's because I'm entering the trade with a strategy, a proven strategy that I've developed over the past 20 years. And in all actuality, it's one of the safest swing trade bets you could possibly make. Why? It's because it's pretty much a guarantee that you have. We had 93 on RSI when I spoke about this last. How much higher do you think RSI could possibly go relative to the history of not just the stock, but of the universe of stocks that have ever traded above 90? It's probably not going to stay there too long. It's all about the probabilities. And when you take a look at the share price relative to not the 2 standard deviation Bollinger Band, which is your out-of-the-box Bollinger Band. I don't use that. I use a modified 3 standard deviation Bollinger Band in red. And as I always like to put it, to keep it simple for those who are learning this business, it's not supposed to be there. And if you have RSI above 90 and you're leaning into your 3rd standard deviation Bollinger Band, guess what? If you buy these shares, you do so at your own peril. So I spoke about these last at 67.42. I mentioned that we would most likely have a price target of the low 60s, high 50s at best. I would be out of this position right now. I would book profits because we could stabilize here and then head up higher. So would I go buying the shares right now? No. We need to wait for a consolidation. You're going to get a rally. If anybody thinks that GOOS, absent of a news event out of the company, if you think that they're going to crash, you're wrong. Strong stocks tend to get stronger. And we will get a rally back. Do we break out to new all-time highs? I don't know. The market will tell me that. But I'm willing to wait for a pullback to a strong support level. We'll identify that with members. A consolidation, a good risk to reward entry point, and then we'll ride it back up higher to the 78, 75 level or just shy of it, and we may book profits. And then we'll wait to see whether or not we break out or do we fail. If we break out, we could jump back in. If it fails, we could either short the shares, which I probably wouldn't. I would probably just take it, scratch it off my list of stocks to buy, and move on to greener pastures. So those are the trades of the day. So before I get over to the pre-market activity, if you have any questions with regard to these symbols, if you're watching this on YouTube, leave a comment below. If you're watching this on the website, leave a comment on the website, and I'll definitely get back to you. Let's move on now to the pre-market activity. All right, we're going to kick things off first with the dollar and gold because they trade inversely of each other, right? So the price action of each must be known before you could trade gold. You have to know it. If you do not know how the technicals are looking on the US dollar and you plan on buying gold, silver, the gold miners, you're like a blind man walking around without a cane. So on Monday, I mentioned that we were seeing lower highs get put in on RSI of the dollar, yet we were putting in higher highs. I'll link to the video at the end of this video. You can watch my commentary there. I won't enter a clip here. But that's what I said. And I referenced the inverse price action on gold. While it was making lower highs on price, RSI was making higher lows. But I said you can't trade off of it. It was too soon. And in fact, I got stopped out of my NUGT trade. I posted on StockTwits. I'm not ashamed of it. It hit our price target where we needed to stop out of it, and we got out. And honestly, I started rebuilding the position at lower levels. Why? Yesterday, the Chinese signaled their willingness to seek a remedy to the trade war. The trade war is what has caused the strength in the U.S. dollar. It's certainly not the economy, because as I just began this video off, I discussed the yield curve. The yield curve is dropping like a rock. So when I saw the news in the pre-market, I said, okay, what is the dollar doing? Here's the reaction of the dollar yesterday morning. It got clubbed. These are all 4-hour charts. It got clubbed over the head, and it's continuing to drop. We broke down below a critical support level. So the markets were sending us a signal in advance vis-a-vis RSI that there was something amiss. Something was going on. The dollar was losing momentum to the upside. Gold was losing momentum to the downside. Yet you couldn't trade off of it, but you had to pay attention to the signal. And that's exactly what we did. So we began rebuilding a position on the gold miners, and we will continue to build that position, because I think longer term you're going to see a big rally in the gold miners. It's in the early stages. They're hated, as is gold. That's why we like it longer term. So the dollar is finding support at this prior trading channel. It was the upper band. It is now a support level. If it breaks, we're going a lot lower. We're going down to, let's call it 93.50. Now for gold is not doing much this morning. It's up $1.10. We have a lot of resistance up here. The 20-period moving average in blue is acting as a declining ceiling. So I wouldn't go running in based upon what I'm talking about right now and buying gold aggressively. It's just a watch at this point in time. It should consolidate. What we'll be looking for are recaptures of support levels, and then we will be buying on strength. Let's get to the major averages. The S&P 500, we broke down. We broke down right here on the 18th of June. We rallied back, flirted with a recapture of a support level, and then failed. This is a breakout point failure. And now we are limping back yet again on the S&P 500. So what we want to do is take our crayon out and connect the dots. These are our data points. If we rally through, let's call it 2776, well then we may hold and we may rally off to new highs. But what I'm seeing here is weakness. And I'm looking at the possibility of this market rolling over. I wouldn't short yet. We shorted the other day. We booked our profits. We took advantage of this sell-off, but we anticipated the rally back. But now I'm willing to entertain reshorting this market on a breakdown, because we have a double bottom setup, and it should. It's a good pattern, right? You want your double bottom setups. You want higher lows. You should get a follow through. But if we don't, if we roll over here and we take out support, you need to be looking to short this market. The NASDAQ, not as weak as the S&P 500, but not wonderful. All right, so here is our line in the sand. We'll probably limp up here to perhaps a high of 7,300 before we hit real serious resistance. I would watch for a rollover at that level or sooner, and if we break this lower band of support here, right here, we will probably roll over and begin to make lower highs and lower lows. So we're up this morning, fairly strong, but be careful. There's a warning flag on the track. The Dow Jones, horrible, absolutely horrible. We're up triple digits this morning, but we have the stochastics, which are, both lines are trading down below the 50 level. And as I always teach members, when you have both lines on Stokes trading down below 50, rallies tend to fade. So I'm willing to bet that this rally today is going to fade, and we'll probably pull back and retest this lower band of support. If it holds and then we rally back, okay, then it's probably all good. We'll probably continue higher. If we fail and we take out the lows of the 21st, it's going to get ugly, folks. So be careful. Let's leave off with Bitcoin. All right, so Bitcoin found a bid. It rallied since the lows of the 13th, and now it has rolled back over again. It looked promising for a while, which is the only reason why I wanted to revisit it here to talk about it. But now it's rolling over yet again. The lower highs and lower lows continue. I would avoid Bitcoin. Nothing going on here except for a world of hurt. So that is it for this morning, folks. Please leave a comment below. If you're not currently following me on YouTube, please follow me. Leave a comment. If you found me through StockTwits, Twitter, Seeking Alpha, follow me there. Leave a comment. Everybody have a profitable trading day and be well.